Toronto Center and Financial Inclusion Week organizers for inviting me and giving me the opportunity to share CGAP's work. So to your question, I think first of all, we should acknowledge that digital finance, very broadly defined, is one of the key driving forces behind the tremendous reduction of financial exclusion by almost 1 billion adults since 2011. So in terms of comparing digital finance with traditional finance and what it brings to financial inclusion, I think we can say that it's pretty good in expanding the access to formal financial services. But of course, we all know that financial inclusion is not only about the access, it's also about affordability, it's about the customer experience, the fit for customer needs, and ultimately it's about the impact financial inclusion makes on people's lives. And we at CGAP sometimes try to see innovation in financial services through that lens of not only access, but also the usefulness and the impact, and looking at the categories of the cost of financial services, how the specific financial service improves the access, how it improves customer fit, how it also improves customer experience, something we call internally CAFE framework, standing for cost, access, fit, and experience. So if you haven't had your cafe this morning, it may be an invitation to have a cup. But we have written extensively about how digital financial services are helping across those 4 categories. For example, speaking of digital banks in different countries, featuring how they have used digitization and digital financial services to improve across those four areas. But what I should say is that, in a sense, I think the question of comparing digital finance and traditional finance and how they contribute to financial inclusion may be a question we should and we were asking 10 years ago. I think nowadays we should say that, broadly speaking, traditional finance has failed. And I don't mean the global financial crisis or other crises that we've experienced, but traditional finance has failed to serve those over 1 billion adults and bring them into the form of financial services. And now we're living in the era where the world is getting increasingly digitized, and therefore we cannot repeat the same mistake and failure with the digital finance. So the question is not even how digital financial services are better than traditional financial services, but rather how we can make sure that the digital financial services are not only closing a gap, but really keeping pace with how the world is digitizing. Because one thing that I think is worth mentioning, and we will probably talk a lot about, is that in the increasingly digitized world, where a lot of economic opportunities, our resilience, but also the way we learn, we entertain, we interact, depends on digital technology. In such a world, access to financial services and access to digital financial services becomes a necessity, because without that access to those other services and parts of the digital economy become virtually impossible. And so I think that's something where we should be asking now how digital financial services can really be accessible to everyone and make sure that everyone can access the increasingly digitized world. And to be able to do that and to avoid the mistakes of the past, I think it's very important to have access to good data and understand the data about financial inclusion, about how financial services help to close some of the financial inclusion gaps. CGAP, for example, has created this impact Pathfinder, which is an interactive tool that you can use to see how access to digital payments, insurance, savings, credit, and so on creates impact, a real impact in people's lives, how it helps them to be more resilient, how it helps them to be more economically active, more productive, and so on. So I think data is very important. I assume Oscar will have more to say on this, and Ruth, of course, as well. So let me pause here.
Hello, everyone. Thanks for the invitation. I'm very proud to join this panel with Ruth, Ivo, and to discuss how digital finance can drive inclusion and well-being across Latin America and, of course, across the world. Just a short thing, by the way, for those who doesn't know what is CAF. CAF is a multilateral development bank that promotes sustainable development and inclusive growth in Latin America through financing, knowledge generation, and technical assistance projects. And digital finance is transforming financial inclusion by breaking down the barriers that traditional finance has struggled to overcome. We can think about geographic limitations, high transaction costs, of course, the lack of tailored products that truly meet the needs of underserved populations. And at CAF, we also believe that data-driven insights are key to making responsible and sustainable financial inclusion. Since 2013, we have conducted 17 financial capability surveys in 11 countries in Latin America and the Caribbean. We follow the International Network on Financial Education and the OECD methodology. And our latest set from 2022 until now consists of surveys in Chile, Costa Rica, Panama, Paraguay, Peru, and Uruguay. And these surveys gave us specific data on access, usage, knowledge, and financial behaviors, helping us design programs that respond to the real needs of the underserved segments of population. And what have we found? First of all, we have important gaps in digital capabilities and trust in financial services providers. There are gaps in financial capabilities and in the use of digital financial services among vulnerable groups. For instance, low-income households, on a regional average, only 17% of this segment use digital services against 54% for high-income households. Women, 25% against 30% for men. Rural communities, 20% against 30% in urban areas. And also people over 40 years old, for instance, 19% of this segment of population against a 39% for people between 18 and 25 years old. In terms of trust, most people don't trust in services provided by online financials providers and fintechs. Only 26% on average of the population trust them in Latin America. So while ownership, access to digital products have grown in the region, the effective use is still low. And of course, we have these problems of trust and confidence in digital financial solutions that is still limited. So this gives us a clear message that we need to work on building trust and enhancing digital financial education, capabilities, and literacy in the region. Because without this, inclusion won't last and won't be sustainable in time. This is our focus in CAF, making a sustainable and responsible financial inclusion, working with different partners in public sector, private sector, academia, among others. So yes, that's for me.
Oh, thank you very much, Ivo and Oscar. I think what I heard from Ivo is that actually, the question of digital versus traditional really is not such a perhaps a resonant one now, because digital has become the mainstream, and the question is then how to make this mainstream digitization, which fits in with the digitization for so many other aspects of our lives, keep pace and go forth to kind of be more inclusive. Because as you have mentioned, in some other areas, digitization itself then becomes a barrier to entry, to access to certain infrastructure. So that's, I think, something that we'll pick up on. And thank you very much, Oscar, for giving us the regional view on CAF. And it's great to know that there are so many studies that are being done. Hopefully some of them are available on the website. If you'd like to talk a little bit
Of
about
course, yes.
where we can find these studies if we are interested.
All the information is on our website, www.caf.com. We have the survey, the 17 surveys data, and also we have like a visualizer, a dashboard that sums up the regional results.
Okay, that's great to know. Thanks for that resource. Okay, I think Ruth will be connecting back into the room. But while we wait for Ruth to come back, I think I'll perhaps move on again to Ivo and Oscar to say that you have both worked on developing digital finance applications or projects. I'm just wondering if you can share some highlights of your work and the impact on financial inclusion and well-being, which is the topic for this panel. Ivo, if you'd like to start first, that would be great.
Yeah, thank you. Absolutely. And I will use example that may be a little bit surprising to the audience, and it's the microfinance. So many may know that SIGAP started 30 years ago to coordinate investments in what was back then a promising financial innovation of microfinance. And 3 decades later, interestingly, microfinance is no longer an innovation, but it is still an important source of finance and financial resilience for many, especially micro and small entrepreneurs in emerging markets, where the microfinance organizations are helping to close at least some portion of the 8 trillion financing gap that exists for MSCs by our estimates. So they play a very important role, but also they now compete with fintech lenders and digital credit providers and other entities that try to get at least some of the clients of the MSCs on their side, of the microfinance organizations on their side. However, many of those new players do not have the capacity to serve what is sometimes called the last mile customers in rural areas, customers who have really low level of incomes, and microfinance institutions are still a critical source of finance for those customers. But in this increasingly digitized world, microfinance organizations need to digitize themselves. And so we set up a project to basically help MFIs transition into the modern day digital era, and started this project with a survey or interviews with many of microfinance institutions, asking them 3 simple questions. One was, have you digitized? And the answer would be overwhelmingly yes. The second question was, has your digitization effort been a success? And the answer there would be a little bit mixed. And then the third question was, so if it was a success, can you quantify it in a specific monetary or quantitative manner, what that success was, what was the impact? And only very few institutions could answer that question, and we feature those institutions in a detailed case studies that you can access on cgap.org/microfinance. I'll just give some examples. Banca Mia in Colombia, for example, launched their mobile app that digitized the workflow of commercial officers and increased their productivity by 27%. It also decreased the loan processing time by over 50% within 1 single year. The same organization also increased the use of digital channels by women by 176% during 1 year, and transactions made by women grown in that same year by 227%. One more example, Amret in Cambodia has grown their portfolio of savings to $22 million using basically mobile savings officers who could travel around the country, collect savings and use digital technology to streamline that process. So we look at those examples and the powerful impact of the digitization projects and ask, can we repeat this with other organizations? And we set up a project that I think shows that digitization can be meaningful, can be impactful, can be cost efficient, and does not require involvement of cutting edge technology like artificial intelligence or some heavy investment into technology, because our focus was on 2 very significant areas, significant in terms of the impact. One, helping microfinance organizations to build a robust business intelligence practice. So basically to work with the data that they already have to better understand the business, better understand the business opportunities, to develop the business, to develop new products. So that was one field of work. And the other field of work was using digital technology to automate the credit renewal process and streamline that process. And many would know that for a typical microfinance organization, the credit renewal constitutes 60+% of their portfolio. So if you streamline that part of your operation, that has a big impact on your P&L and generally can improve your business. And that's what we've seen. We actually, within a year, working with 27 microfinance organizations, have helped them to improve the business intelligence. And with some of them, we have helped them to redo the credit renewal using some simple technology and helping them to reduce the decision-making process by days and reduce the cost involved in that whole process. The project ended there, proving that it's possible and it works. We haven't really followed with the MFIs to the more exciting stage, which is how do you now use the cost efficiencies? There are many ways how MFIs could do it. They could expand their portfolio, build new products, improve the quality of the portfolio. They could also use those newly gained capabilities to start building new types of digital products. But again, I think it's an interesting study of what digitization actually is and what it can do and what kind of impact there can be. And you can see the details of it at cgap.org/microfinance if you're interested.
Well, thank you very much. Oops. Okay, thank you very much, Eva, for sharing those examples in microfinance. And from what you say, it seems to be really much scalable across the many microfinance institutions. And the other point that I picked up on was that it was not rocket science to get. It is more of like incremental improvements, and that actually, if you aggregate it across the whole industry, actually makes quite a bit of difference in the end. So I'd like to invite Oscar, and I think we have Ruth online as well. But Oscar, if you could, share a project that you're working on, and then I'll get Ruth to come in and
okay,
comment.
perfect.
Thank you.
That's okay. So in CAP, we have this extensive financial inclusion and financial education program. We work in 6 main areas of action. The first one, as I mentioned before, is the knowledge generation. In this matter, we have our financial capability service. We also work in public policy and regulation. We have supported 17 countries in the design, the implementation, and the evaluation of national public policies and national strategies for financial inclusion. We also work on financial literacy, financial inclusion with a gender focus. And we have a special project that is our Financial Inclusion Lab. It's one of our flagship initiatives. And we launched this program in 2019 to basically support innovative digital solutions that improve the financial inclusion of underserved population, of MSMEs, again, in Latin America and the Caribbean. And with this project, we also seek to strengthen the fintech ecosystem with a focus on financial inclusion and financial literacy across the whole region. We have worked on digital solutions focused on promoting the financial inclusion of women, of migrants, of micro and small businesses, AI-based solutions, and currently we are developing our lab on the 7th edition of our lab, focused on financial inclusion of rural communities. And over the previous 6 editions, we have received more than 1,000 project applications from across the whole region, and we have selected 50 winners, which are impacting 14 million people and 90,030 MSMEs in the region. And in the lab, we have identified some trends that are driving financial inclusions. For instance, digital payments for underserved populations, productive credit access through digital channels, fully digital channels, alternative credit scoring using non-traditional data such as spending patterns, bill payments, for instance, rent, utilities, phones, social media data, or even text or voice data from customer service calls. Other thing that we have found is the climate resilience insurance that are leveraging satellite information, historical climate data, and machine learning. and the financing of supply chain and loans to purchase supplies across the value chain for rural MSMEs in the agriculture sector. And lastly, one of the things that have impressed us the most are the financial education platforms with AI-driven advice tailored to support and incorporate the financial inclusion and financial well-being metrics for their users. This is showing that technology combined with education and with strong partnerships can deliver measurable improvements in financial well-being. And we have received and selected winners across the whole region, mostly in Mexico, Chile, and Colombia. But we have also winners from countries like Ecuador, Bolivia, Peru, Uruguay, Argentina. So we are very proud of the things that we have done in the lab, and we seek to promote and to foster the fintech ecosystem, again, to foster digital financial inclusion and financial well-being.
Thank you very much, Oscar. I think that's a fascinating look at the landscape, and it's really amazing how many applications that have come in from the whole region. And I also hear what you said about, it ranges. There's a whole range of tools being used. There's AI. There's the intersection of climate risk, which is really extremely fascinating. So we have Ruth, and Ruth, if I'll just ask you to comment on where we left off, on the general question that we started with, or what you're hearing from Ivo or Oscar on the projects that we've worked with.
Great.
Ruth, please go ahead.
Great. Thank you, Chinwe. Can you hear me?
Yes, we can. Yes, we can.
Lovely, lovely. Well, it's been a pleasure to listen to my panelists, even though I've been the one who've had technology issues this morning. So I thought, though, I would just reflect on the comments and think back to your original question, Chinwe. How does digital finance enhance financial inclusion, and what does it do better? So I would remind us of the G20 policy brief that really speaks to the goal of financial inclusion, and that the goal being for all stakeholders, providers, regulators, supervisors, is to enhance the well-being of people and their financial well-being and their resilience. The G20 brief also provides a really broad working definition of financial well-being, and I think it's worth remembering that. Of course, given the levels of and the complexity of poverty, there's many factors that influence the well-being of people. One of them being access, convenience, and then, of course, the financial capability to take advantage of those opportunities. And Oscar's does very, very interesting work on that. Now, very quickly, thinking about Findex and also the CGAP Impact Map Pathfinder, we have really clear understanding of the benefits of what digital finance has allowed that microfinance or traditional finance just couldn't. And one being the proximity, the convenience of close, immediate savings. So governments and employers sending wages and government subsidies into people's mobile money accounts or digital wallets has really increased the safety and security of cash for those people, and their resources, protected them in that way. It's also really enhanced the savings rate. I mean, that was a shock for me looking at the most recent Findex, is to see the level of savings that has been mobilized, and that continues to be mobilized in very, small, secure ways. Years ago, in the microfinance sector, for example, there was much pearl clutching over why there was no usage of many dormant accounts. So there are many problems that digital finance has solved for people: payments, savings, a safe place to save, and connectivity with people. So the recent Findex also speaks to the benefits of connectivity in digital finance. Access to mobile phones and the internet is associated with reduced poverty, with increased consumption. And there are a growing number of reports to confirm that, and more employment opportunities for individuals in low and middle income economies. Women can also take advantage of these opportunities, and they have done so, better able to access jobs, more flexible jobs, and increase their own labor force participation. And of course, connectivity in mobile phones also increase social networks, communication, and connectivity in times of emergencies and shocks. The IMF conducted some research some years ago in a report asking, is digital financial inclusion unlocking growth? And they had some very stark findings, and that showed that digital financial inclusion is actually higher where the use of traditional finance is high, but where access is limited. So technology or fintech has actually helped to fill that gap left by the traditional financial institutions. And that includes some of their challenges on inefficiencies and also the lack of competition. So fintech is also higher where individuals have higher financial awareness and trust in the financial system. And that's another big thing that the traditional inclusive finance sector has really built on, is that notion of trust. And we need to do more on building trust in digital platforms to reach that remaining 1.3 billion. Another key point that the IMF report calls out is that individuals need to have access to the digital infrastructure. So they need access to internet, access to mobile phones. And for the financial sector, that is, in my view, a recognition that we need to remember that it's not simply the financial service provider that works alone in this ecosystem, but there is a role for electricity, for telecoms and the network towers that provide that kind of access that people need. So there's a lot of reflections that I have. And I think before I stop, I'll just say that the data from Findex and elsewhere, I think, still leaves the big question for us to address. And that is, how do we help financial inclusion, access and usage now translate into financial well-being and resilience? And again, the Findex data is not very much changed from 2021, where a lot of people continue to worry about managing monthly expenses, about paying for school fees, and about coping with shocks. And of course, digital finance also then raises an emerging number of new risks and new challenges for us all to consider. I think I'll stop there.
Thank you very much, Ruth. And actually, I hear some questions that you ended your intervention with, which is really what next? How do we reach the remaining billion, or how many unserved customers there are? And you also mentioned some risks. I think in the programs that we run on digital financial services, we do equip supervisors to the skills to identify the risks and then to manage and supervise those, so that digital finance can be allowed to realize its full potential. But perhaps I can invite Ivo, Oscar, if you'd like to comment on this question, what next? How do we go forward? And I also see we have a question in the chat. We'll pick that up, and a shout out to all participants. If you have questions, please do put them in the chat and we'll pick them up shortly. Okay, so Ivo or Oscar, what next after this? How do we reach the point like this?
Well, so I will say that, again, we need to really underscore the message that the paradigm has shifted towards the more ubiquitous finance that underlines many human activities, commercial or non-commercial finance, as an enabler for many other things. And I think Ruth made that point very clearly. And it means that in this highly digitized world, involuntary financial exclusion is basically not an acceptable policy outcome. And policymakers, including the financial sector regulators and supervisors, have really a critical responsibility in ensuring that the new paradigm that is emerging is more inclusive. And I think one area where more can be done, and that you highlighted, is the area of risk-based approach and taking more risks, more informed and measured risks, to allow the potential of digital financial services to really do the work. I'll just speak of one specific area where I think a more experimentation would be very helpful. The Findex consistently features the lack of documentation among the key reasons for why people don't have access to financial services. A big part would be a lack of ID that can be used in customer due diligence that is required for anti-money laundering and anti-terrorist financing purposes. At the same time, the Financial Action Task Force, the international standard setting body, very clearly says that if there are low or low risk scenarios, such as customer who poses very little money laundering or terrorist financing risk, the policymakers and institutions can relax those customer due diligence measures and enable customer onboarding with minimum or no documentation. But so far, the main materialization of that opportunity is so-called tiered KYC regimes, which are a great step towards more access, but not necessarily a step necessary to expand the access and deepen the financial inclusion. And so that's one example where we can do much more work using the technology and innovation to deepen the financial inclusion. But again, broadly speaking, there are many such pockets where more work could be done, and regulators are generally faced with this opportunity to harness innovation for inclusive finance and for other policy objectives. And in fact, in many markets, they are expected to seize this opportunity and help their markets to leapfrog, right? And I think what is important and what we're finding in our research, which is soon to be published, is that regulators who have succeeded so far in harnessing innovation to advance a mix of policy objectives, including financial inclusion, and doing it in a responsible way, are regulators and supervisors who follow what we call a vision-guided financial regulation. It's a sort of a concept that revolves around 5 key elements. Vision, obviously, tone at the top, innovation culture, industry engagement, and mandate. Because we're finding very consistently that regulators who have a clear vision where they want to push the financial markets, and very often where they want to push their economies and countries, are doing a better job in selecting strategically where to focus their attention. We're living in a world where a lot of things are happening at the same time, a lot of opportunities and risks emerging at the same time. And so that is why having a vision is critical, because it helps to triage and focus attention. And then it also goes with the tone at the top, where again, the top leadership kind of sends a strong signal that innovation matters, a measured risk-taking is welcome, responsibility is required, right? And there's a space for experimentation and innovation with doing new things, because as we said, to bring over 1 billion people who are still excluded from the formal financial system into the formal financial system would require a more than what have been done in the past. And the tone, the vision, it promotes innovation culture that is, I think, characteristic by the measured risk-taking, something that may be a little bit a strange concept to regulators and supervisors, but really an experimentation that is informed and that is safeguarded, for example, using the concepts like regulatory sandbox, is necessary in this fast-paced environment. And then the other element, industry engagement and mandate, are a lot about the legal grounds for regulators to experiment, take the measured risks, and for example, introduce new types of innovations, and keeping the ecosystem informed of those actions and of those plans through the industry engagement. So again, we're publishing a report on what is the vision guided regulation and how regulators from Singapore to UK, Malaysia, Thailand, Brazil, and others, how they have implemented this vision-guided regulation in their jurisdictions, but not as a one single blueprint, but rather as a new type of mindset or approach to financial sector regulation that is perhaps more suitable for the 21st century and for the fast-paced world where digitization matters a lot because it connects the economic activities and the other activities through the finance and through the access to the finance. One more point that I'd like to mention is that vision guided regulation is also important because due to the, I would say, the very vibrant financial ecosystem with many types of innovation, it's very important to keep a big picture in mind. I mentioned microfinance before. 30 years ago, CGAP could have very easily just focused on how to optimally regulate microfinance industry. Later on, we could have comfortably focused on how to regulate mobile money providers because these were important vehicles driving financial inclusion. But nowadays, there are so many things from decentralized finance to artificial intelligence, cloud computing, quantum computing, etc., that for the regulators, it's a luxury to just focus on one specific vertical or one specific innovation. They really need to keep track of what's happening and how it all adds or not to that big vision that they have. And that big vision may be actually not only vision for the financial sector, but also, as Ruth alluded to, it can be the vision for the entire country, nation, region, and would require more than just financial sector-oriented work, could require work on building the electric grid, building the cloud computing centers, making sure that there's enough CPU for artificial intelligence to serve the particular entity or country. And so the vision, again, could be at multiple levels, but it's very important to have one as a guiding principle for regulatory efforts.
Well, thank you very much, Ivo. I feel that you have spoken actually to the question that came in from Jayashree Venkatesan, and speaking to leadership and organizational champions as enabling factors that contribute to DFS being rolled out responsibly. So I'm just wondering if you could just touch a little bit on the CGAP's work that Jayashree is asking about, and then due to time, we'll ask Oscar to give us his call to action for the financial supervisors and regulators, and then we'll close with Ruth doing the same. So Ivo, perhaps a few words to Jayashree's question. Thank you.
So I'll just be very brief, and I will direct the audience to the great work that my colleague Eric Duflo and Juan Carlos Izaguirre are doing around the concept of responsible digital finance ecosystem, where they actually speak of the importance to really work with the leaders and key stakeholders, not only in one specific area of financial consumer protection, but across the whole ecosystem, and make sure that everybody's aligned behind the vision of positive customer outcomes. So I won't say more in the interest of time, but go to cgap.org and either look for Eric and his work or just look for the responsible digital financial ecosystem work, and you will find more.
And thank you, Ivo, and thank you, Jayashree, for the question. Oscar, your call to action.
Okay,
Yes.
really quick. That I would say that supervisors and regulators are enablers of digital innovation. Of course, it is important to adopt proportional and risk-based frameworks, but it's also important to engage with the innovators early to understand better the business models, the impact that they are having on underserved population. And by doing this, you can create an environment where digital finance thrives responsibly. And at least this is the experience that we have had in our laboratory, our financial inclusion lab. We have built a network of more than 100 partners, including regulators, supervisors, financial institutions, support institutions within the tech and entrepreneurial ecosystem. And this is one of the key lessons: engage policymakers and regulators early in the process to better understand to better understand the things that they are doing and the impact they are having. And I mean, the future lies in innovation, fintech development, digital payments, open finance, pro-innovation regulation. Ivo mentioned, for instance, the sandboxes, regulatory sandboxes. So I think these are the things that we are seeing for Latin America and the Caribbean. And of course, digital financial education is the priority, again, to make it sustainable in time.
Thank you very much, Oscar, for that. Engage early. I see a question from Juan David Hernandez Liao. What strategies can be implemented to reduce potential privacy concerns that may keep people from using digital finance? Perhaps you can address that quickly, Ivo?
Oh, we don't have much time, so I just say a robust data protection and privacy frameworks that are supervised and enforced is a way to institute the trust. I would hope, and it's a very important question, obviously, in times of open banking and open finance, which are very potential innovations, but require that level of data protection and privacy protection that are legislated.
Absolutely, thank you. Any last words, Ruth, before we close in about a minute or so?
Yes, I would say leverage the data of Findex. We know that of the excluded, most of those, 53% of those 1.3 billion fall into 8 economies. So there may need to be customized, bespoke kind of approaches for them. It's not business as usual. Secondly, we need to leverage about who's excluded. The poor, the rural, youth, the uneducated, the low income and the unemployed particularly. We may need to look for pull strategies to embed finance within other programs and look to see how we can include those folks. And finally, to the regulators and supervisors, the world has indeed changed. There needs to be much more robust supervisory technology kinds of initiatives, and we heard a lot about that from CCAF yesterday. A lot more collaboration with the consumer protection agencies, with data privacy frameworks and legal mandates. But it is a time to collaborate, work together, because if we don't, the digital divide is going to just completely really make a big, unhealthy, high-risk kind of environment for economics today.
Thank you. And we'll have to leave it there for now. Thank you very much, Ivo, Oscar, Ruth. It was a great session. Thank you all.
Thank you.
Thanks.
Thank you.